Hey, what's going on, everybody? This is Mark from Solar Games, and today we're going to talk about a topic that I think is very interesting, but also very necessary, I think, for a lot of people, especially people on my channel. We're going to talk about why most people fail in investing. Most of the time for the content of this channel, we focus pretty closely on magic cards and the financial aspects of those things. Of course, for this video, I will take a step back. We will look at the financial system as a whole, more or less, and not specifically focus on magic cards. As a disclaimer for videos of this type, of course, is that the comments and opinions expressed in this video are of my own. They are for entertainment purposes only. They are not financial advice. I am not a financial advisor. I'm not telling you how to trade, nor advising any aspect. Okay, so entertainment only. Let's have fun. So the first thing you want to understand is that there is a concept of market sentiment, how you feel about the market, right? And that usually trails the actual market, meaning if something is about to go up, right, asset or whatever, the market's recovering. Usually you are still in the valley and you think something like, hey, it's not that great, right? If the market is about to crash, most of the time, most people on the market are going to be like, no, this is going to continue to go up. The market sentiment always trails the actual market. And again, that's normal. How you feel will lag the market because, again, you're seeing past data and making future judgment. So, of course, you can't predict the future. No one can read the future. And again, most people, what they're doing is they're just chasing the larger institutional traders, your larger investors. I remember as a kid, like watching these movies in China, like I think this is like the 90s, and you would have people who would like, the Chinese investors would sit in their rooms with like special boxes. This is back when you had to trade at the exchange, and of course you had the smaller traders who would be on the floor watching the moves of the large traders. Like, what are they buying? What are they selling? Who are they talking to? Like, you're physically chasing them, kind of thing, right? You're trying to like get close to hear what they're saying. So they follow those kind of things. Of course, those large investors, the smart money, they are moving, or at least they're trying to move ahead of the curve, the market curve. But unfortunately, most normal people like us, we are going to be trailing that curve. We're going to be following what happens. Like, for example, here's a good example, right? So this week, or this past week, the whole SVB failure. So as you know, one of the pretty big banks that is securing loans or deposits for a lot of Silicon Valley startups basically had to go insolvent, bankrupt. And the whole reason is because all of the depositors went in and started trying to take their money out at the same time. As you know, for banks, a lot of times for them to make money, they take depositor money and they're investing that. So they're earning something on that deposit. So that's how they make most of their money. Well, the problem with that is usually when you invest something, you can't just liquidate it instantly. It's not illiquid, but it's not like super liquid, right? It's not like cash. You just withdraw it out. So unfortunately, when everyone goes and grabs their money out, well, you're going to have a problem because you can't liquidate the asset quickly enough. And of course, if you want to liquidate asset quickly, you have to sell it for like way less than what you're basically what they're worth. And that's normal. This is very common, right? If you, for example, imagine if you try to sell like one apple, let's say an apple is like, I don't know, 50 cents, fine. But if I try to sell like a million apple, yeah, I'm probably not going to ask for 50 cents. I may even ask for like, I don't know, 10 cents, 5 cents, right? Type of thing. Because again, you're trying to liquidate a large quantity of something. And now there's time urgency. It's not like, hey, I can do this. I can sell a million apple, but I have like a million years. And I don't care. I can sell one a day and also be fine, right? Whereas one a year and also be fine. Whereas they have to liquidate really quickly to, again, meet the obligations of the depositors. So, long story short, why am I bringing that up? Well, guess who had information to basically sell the stocks of SVB Bank ahead of time before this whole run on the bank happened? The executives at the bank. Now, whether or not that's going to go to charges of insider trading, very likely, by the way, is up to FTC, not up to me. But I'm just telling you that's how it works. These smart money are usually ahead of the curve. They know what's going to happen. And of course, they tell their friends, and their friends are the first to withdraw their money, right? So they're, again, ahead of the curve before the other people realize what's happening and potentially lose their deposit, right? So Not diving into that too much for this video, but just ahead, again, letting you know kind of like example of what being ahead or behind the curve looks like. So of course, market follows apex and troughs, or up and down, whatever, low, highs, etc. So what causes like an apex? What causes that high? Well, basically apex, right? The terminology is that it's the highest point of market value. So essentially, like it's whatever asset may be is the highest that asset is going to be trading, right? At least in the local time horizon. So within a year or whatever, that is the highest, that would be the apex. And in general, at the apex, you are looking at a negative inflection, or just an inflection point, meaning the rate of change is going to be decreasing. So essentially, like it's going to go negative, right? So instead of like continuously increasing in the actual rate of gaining, it will actually start decreasing. That's what the apex means. And again, simply put, it's the highest number you can sell your asset for. Yeah, just think of any like market boom, the bubble before the crash type of thing. And usually at the apex, market sentiment is super hot. Everyone thinks this asset's going to go up forever. People are buying like crazy, right? That's usually what's happening at that time. The valuation skyrockets on everyone thinking that the future will be better than today. And of course, at this point, most of the investors who are pretty smart about what's happening start taking money off the table. They start selling back into the market. Now, while the smart money are selling the whatever they're holding, what you'll see is normal people will start gobbling up those assets. Again, they're thinking, like, look, Tesla's gone up, 700%. It's going to go up another 100%, no problem. So they start buying at this price, even though people are selling it, right? And so, of course, that's going to be fine. You're going to have market stability, because as long as transactions keep happening and they keep happening at higher prices, then who cares? Of course, the problem happens when there's more and more of the sellers come to the market. They try to sell their positions, and less buyers have confidence that they can continue buying at a higher price. So that's where the price starts falling. And that's literally what happens in a market where you have so many sellers and the buyers don't want to buy anymore. And of course, it goes down. And usually when that fall happens, people start panicking, meaning more buyers, people who may have just wanted to hold Tesla, let's say at $1,000, decide that they're going to sell now, because what if it goes down more, right? And so kind of like this, again, I'm using Tesla as an example, but you can take any stock really, like Twitter or whatever it is, right? Any stock really, Hasbro, and it will work the same way. And okay, there are other like economic or social, like global factors, like COVID caused the crash of like 2020, right, in March. 2008, financial crisis with respect to mortgage-backed securities. Again, things like this, they're going to cause problems. They're somewhat outside of that company's control. They're a global type of systemic risk that affects the entire world and all the economies. But in general, like at some point, there's a point where there are more sellers than buyers. Of course, that's what causes a crash. And okay, so let's talk about bottom. What causes a bottom? Well, a bottom basically, first of all, definition is that it's the point where the market hits the minimum, meaning your asset value has dropped to the bottom, and the rate of change is actually turning positive, meaning now we're no longer losing value. We're actually maybe slowly, maybe quickly gaining value, right? And you can actually see what happened here. As an example, a couple days ago with SVB's failure on Monday, I think like a lot of bank stocks went really low. And if you remember, like First Republic Bank also hit I think at a high point, they were like 150, I think, price per share. And of course, due to all this debacle, whatever happening, they fell as low as $19. So I would say like around that 19 point is their bottom for that bank. As you can see on Tuesday, right away, they bounced right back to 50. I haven't checked the stocks. I don't know where they are now, but like we're talking on like Wednesday night, Thursday morning type of thing. It's like, I think it's past midnight. Yeah. So anyway, that's what a bottom is, right? It's coming back up. It's you've hit the lowest point and the inflection is kind of coming back up. Market sentiment at this point is like very, very low. People don't have faith in the asset. They think it's going to go lower. And usually the valuation is at the bottom. Like, in fact, a lot of times at the bottom, the valuation is so low that it is lower than the actual worth of the asset. And this is what basically drives the smart money to come into the market for two reasons. One is most people are exiting, so they're trying to sell the asset for as cheap as possible, and essentially they're just trying to get a quick sale and get out of it. Because there's going to be more buyers, more sellers than there are buyers in the market, the smart money can come in and actually gobble up a lot of the assets for really, really cheap. So again, back to the SVB example here, there's a bunch of other banks that came in to help save SVB by like buying up their treasury bonds, which are pretty secure. But basically, the price I think I heard to negotiate for a large portion of their asset here, the treasury bonds, I think they purchased like at 33% or 30% of value. So imagine if like treasury bond is like 10K, they paid like $3,000 for it instead. And of course, when that treasury bond, the 10-year treasury, whatever, matures, they're going to get $10,000 back from the US Treasury because, again, that's a promissory note from the Treasury. And realistically, unless like entire US goes bankrupt and we're done, the Federal Reserve will meet the obligations, whether they can collect it from taxpayers, whether they print the money literally, they're going to give you the 10K. So you're kind of fine, right, to do that. Yeah. So again, basically right now, total capitulation. Everyone's exiting the market. Nobody believes in the asset. They're selling pretty much at any price, and you'll see smart money moving in, buying the asset up. If they believe in it, if they believe that the actual worth of the asset is higher than what people are selling it for, they're going to gobble it up, and they're going to pay you a little bit more, probably, usually for the asset than pay you less than what you think you can get, but they're going to take a lot of it. And this is like what happens again, and even for me personally too, right? Like in collection buying, if somebody's like more desperate to get like money, well, guess what's going to happen? Like, you're trying to sell me this many cards, this is the price you're going to get. It's kind of normal. Yeah. So that's why it actually turns back up. Again, it's because at the bottom, a lot of the rich investors, the people who kind of are seeing the future, they are seeing that the type of asset, it's actually worth owning long term. It's cheaper than what it should be, and that's why they're buying in. And then, of course, them aggressively buying the asset will also drive the price back up. And of course, that changes the whole sentiment of the market. More and more people start buying. Of course, that's what lifts the whole thing up. So that's kind of how you get out of a bottom, right? So now that we understand apexes and bottoms, so why do most people lose money? Like, I mean, if we just take this example I just gave you, why not buy low, sell high? Pretty simple, right? When Kaladesh, so I'm looking at a booster box of Kaladesh here. When Kaladesh, if each pack of Kaladesh hits $2, I'll buy it, right? Why not? Makes sense, right? So why not buy at the bottom and then sell it when Kaladesh is what I think is worth around like $10 per booster pack now, something like that. Anyways, right? So you can see the reason why most people still lose money, even though they understand fully what I've just, spent like 10 minutes telling you about, is because the most opportunistic time to actually buy an asset is also the most scary time to go buy an asset. Imagine you're in that moment, right? When everything looks bleak, people don't even have faith in the future anymore. And you're the person who's buying the thing that everyone says you're a sucker for buying. Okay, so take crypto, for example, right? Crypto is going to be, it's a hot topic. Everyone loves it. Bitcoin. At highest, Bitcoin hit 60K, something like that, right? I'm not exact, but around that range. Bitcoin right now is what, 15K, 14K? If Bitcoin dips to 8,000, would you buy? See, the problem is in that moment, you're thinking two things. One, you're like, if you actually are serious about owning the asset long term, you might be thinking, well, what if it becomes 7,000 tomorrow? Let's say Bitcoin's 8,000 right now, right? You might say, oh, what if it's 7,000 tomorrow? Maybe I wait until tomorrow to buy. Or how about this? Maybe I just wait until Bitcoin shows me that it's actually 850 tomorrow, I'll buy. But then, of course, tomorrow it actually drops down to, let's say, like, I don't know, 750. Do you buy now? You're thinking, oh, good thing I didn't buy yesterday. See, I'm looking for an upward trajectory, and it's not showing me that. So I'm going to wait until it gets there. So 750, I'm definitely not buying it. This is the problem. A lot of times, the most scary point in like a lot of this kind of asset stuff is that that's the point nobody wants to buy. So only people with like a lot of, I don't know, gut, smart, stupidity is actually willing to put the money down for those things. Of course, most of the time you think it's kind of like a gamble, like, hey, I'm buying something at this low point because, oh, I'm just going to take a risk on it. Most of the time, though, it's not. Like a lot of smart investors, they don't just buy everything that's low. they're usually thinking about worth, at least, justifying for themselves what the thing should be, and then understanding like intrinsic value, book value, etc., and noticing how, for example, stock price is below intrinsic or book value. And that's when they actually usually get into the market and say, look, if you buy it, it's like a no-brainer, right? Similar to like what happened with the whole Lord of the Rings gift bundle. Like if you did the math, you're like, so the gift bundle is like cheaper than the set booster. So why don't I just buy the gift bundle? And then I get actually all this bonus stuff too, right? That's exactly how it works. How it feels if you're a smart investor at the low point. You look at the price and you're like, that doesn't make any sense. Execute. But one of the other problems is also what happens. So like if you have no horse in the game, you're just kind of waiting for the low price. Actually, that's not too scary. The scary part is, let's say you're holding the asset, and let's say you're holding the asset and you bought it at a much higher price. Let's say you spent $100 buying Hasbro stock way back, was like a year ago, and now it's worth like $50. Do you sell? Do you hold? I mean, general recommendation would be you hold the stock, because you already lost half. You're not really going to go anywhere. You hold the stock. But a lot of people, when they see like a tick down, they're going to say, I want to sell. I don't want to lose any more money. I've already lost $50. I can prevent losing another 50, right? By selling it now, I can recover half of what I had before. And the lower that stock falls, the more people feel this way. And that's why they exit the market earlier, etc., before they really should, right? There are some ways to kind of get out of that. But the problem is your sentiment is fighting against what you actually should be doing, right? Again, the second part is also no one can actually determine top and bottom. Everyone thinks I'm going to buy low and sell high. The problem is, what is low? What's high? When has something peaked? Like recently, a lot of my family members have been asking me, hey, like Mark, it's a good time to go buy a house. Honestly, I don't know. I mean, the housing market here, at least in the Bay Area, is a lot lower than before, right? It's pretty decent price, time to buy. I see homes go on the market and they're just not selling. And a lot of people are kind of cutting down the price. And it's been many, many years since I've seen people bid lower than asking and actually getting the house, right? So definitely it's a good time to buy if you think about it from that perspective. But then the fear is, well, what if I buy, let's say, even at 1 million for whatever house, and it falls down to like, I don't know, 800K, 750. So I lose another $250,000. Yeah, it's a big concern, and no one knows. Who knows? Maybe tomorrow, we realize there's a housing shortage, and so that that $1 million house becomes 1.5 again. No one knows, right? And that's the key, is that even if you think you know, you don't know. Nobody actually knows, and there's always these like external factors that can happen. What if there's a war? What if there's a war on the West Coast? And guess what? Everywhere here is not safe to live. What's the real estate price here? People are going to sell like crazy, right? So no one knows what the future is going to hold and tomorrow is going to bring. Nobody knows that. So you can't really time the market for low or high because you don't know. And the people who tell you they can time the market, just history and a lot of data has shown that they just don't. They just can't. Basically basic data tells us they do just as good as average about. So they can be smart. They can sometimes get lucky, but they can't consistently get lucky, right? It's very rare that happens. There are some people who can do it, but it's only because they're investing differently. So anyways, again, so on the flip side, when asset values are on the rise, most people look at the trajectory and say, okay, I'm going to buy it more because of future possibilities. And you see this, like you saw this in, I think it was like 2021, beginning of it. After the whole COVID low, it went skyrocketing, especially for these like what they call stay-home stocks or Wood stocks, right? From Cathie Wood's portfolio, ARK Invest. And the whole idea is like, look, everyone's at home. They're going to be using Facebook, all these like apps. So the app stocks should be much higher. And of course, people went crazy on those. And other companies looked at it and says, oh, great time to IPO. I'm a at-home stock too. Or I somehow help COVID, during the COVID times. So people started getting really, 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 really optimistic about all these stocks. And so they went crazy on the valuation. And so most of the valuation back then, you see what most companies, how they evaluate. It's like, well, future growth, future potential. What is my revenue going to be like later, right? Based on users and stuff like that. The company could literally be losing money and their valuation is like, oh, I'm worth like 100 billion. How can you lose money and be worth 100 billion, right? So that's usually a good sign that you're hitting a bubble. You're getting too hot. Now, the problem with this, and Michael Burry learned this in 2008, is that even if all the evidence point to a problem and it's a bubble, it doesn't mean that you can time when the bubble will pop, right? And this is why, so again, the specifics of how a lot of people lose money on a bubble is they'll, even if they think the market is going to come down and they're correct, it's that they get the time horizon wrong. So especially when you're buying things like options, right? Options are very scary because while they are very good at multiplying your wealth, because you can essentially trade, let's say like 10% of a stock and earn like, your multiplier is high, but you could also risk to lose everything, right? With the option. Whereas stocks like, so Hasbro loses 50%, I lose 50% only. With the option, if that option you can't execute it because it's lower or higher than what you pegged it at, you could lose the entire option. That's very rare for just a stock. So again, that's, option contract. Maybe I'll explain one day. Not a big deal. Don't worry about it too much. My recommendation, if you don't understand what it is, don't trade it because it's very difficult to really come out ahead on options. But again, the reason why Michael Burry, the guy who basically knew that 2008 was going to crash, he couldn't get the timing correct. And so he bought all these option contracts that were expiring and he had to go renew them for more money. And the problem is, well, you're losing money even though he was eventually proven correct. And of course, when he was proven correct, he got paid out a lot. But by then, a lot of his investors have withdrawn their, investments, they've cashed out. So yeah, this is what happens, right? So like, even if he's correct on the trajectory, he's wrong on the timing, and that doesn't help either. Yeah, so again, on the high rise, everything like that, people are saying things like, oh, it's like future potential, not on current worth is how companies are being actually like valuated, right? And this is the worst time to buy into a market, but most people will be buying into the market at this point. And that's because they think, hey, it's going to go higher, right? My Snapcaster Mage is going to be $70 next year because it's the best card in Modern, right? Every Spell Slinger deck needs a Snappy. Yeah, until of course the meta shifts and you get dinged. Yeah, so again, this is the problem, right? So you have these rise and falls. Most people don't actually know how to time it, and because most people cannot time it, they actually will make the wrong decision at the wrong time. Sometimes people get hit both ways. They buy when it's rising, and they sell when it's sink to the bottom. So you can imagine like something, let's say a card, let's say we'll take Underground Sea, right? Good example. Underground Sea at some point back in 2020, maybe during like, let's say March, was around like, think 400-ish, 370, 400, that range, revised Underground Sea. Of course, come 2021, that card was worth like 1,000, I think. And it's been holding at 1,000, maybe even higher than 1,000. I think at some point it was like 1,200, some like ridiculously high price, right? And of course, people were still buying. I mean, why is the price at 1,200? Because somebody bought it at that price. And of course, that card quickly fell down again in the Magic 30 announcement. So you can imagine somebody buying the card at 1,200 and then realizing at Magic 30 announcement, oh my gosh, this is terrible. Sold it at like, I don't know, $300 to a buy list. So they lost both on the up because they bought it at 1,200 and sold it for 300. So they lost like what, $900, and they can't even like recoup some of that because right now I think Underground Sea is back up to like, I don't know, 700, 800-ish. So they can't even recoup the middle of that too, the re-entry. So, and usually somebody like this is very burned by the market. They're not going to come back. They're going to look at Underground Seas at 300 and say, I'm never going to buy that card again because they got burned, right? So that's exactly what happens. And that's why it's so hard, because essentially your mind, your mentality, the way you think is working 100% against you. And that's why a lot of people say, you can't take emotions into investing. You got to look at the cold hard facts and make decisions on cold hard facts. And this is also why a lot of sales strategy is all about getting you emotional about something, right? Oh, look at all the crime rates. Crime's everywhere. Go buy a fire alarm. Works. Hey, are you you don't have a girlfriend, right? Must be because you're losing hair. Keeps. You see what I'm saying? Like, think about all the way that they're trying to manipulate you through emotion to make you, buy something or whatever. That is how the world kind of works, actually. So next time you feel something, you feel very strong about something, before you make an investment decision, take a step back, think about it. Think about the investment decision. Don't buy something just because all your friends tell you to buy it. Buy it because you actually think it's a good buy, right? And again, same on the flip side. Don't sell something because everyone in the market tells you got to sell now, otherwise you're going to lose all your money. Think about it and then make a decision. I'm not saying that it's always a bad idea to sell at like the low, because yes, if you, for example, own stock in a newspaper, probably sell it right now. I'm just going to be honest, or if you own stock in, I don't know, traditional television, cable television, probably cool to sell. It just I don't know, like ideas here, right? Yeah, so I think I'll basically end this on a quote from Warren Buffett, which, if you guys been in the channel, somebody I really admire. You have to take a contrarian perspective a lot of times when you invest. And so Warren Buffett says this: be fearful when others are greedy, and be greedy when others are fearful. I will add, this is very hard. It's not easy to do that, but it's very necessary. Mark Solo Games, I hope this video is helpful. Some of you guys might notice this graph I have in the back here, because it's very hard even for me. A lot of times I also don't think I make the best decisions. Flesh and Blood Alpha Boxes is probably the worst mistake I've made on the cardboard investment side ever. But you learn, you move forward. So this chart is basically the market sentiment and actual market too. So I'll attach this chart into the description. You can download a copy. You can hang it on your wall. Highly recommend it, especially in the low times when you feel like everything's going to go to shit. Just again, before you make a decision, look at the chart, think about it. Turn off your croc brain, turn off your emotional brain, and turn on your logical brain, and really think about, does it make sense? Is this the right choice? Yeah. Mark, Solo Games, have a wonderful day. Don't worry about it. Stay classy.